The 30-year fixed mortgage just hit 6.7%. 3 months ago, it was under 6%. All that progress, gone. Let me break down what's happening, why, and what comes next. So here's the timeline. Back in February, the national average on a 30-year fixed dropped to about 5.87%. If you were house hunting, that felt like real relief for the first time in years. But then mortgage rates started climbing. By late March, we were back above 6.3%. And as of this week, we're sitting around 6.63 to 6.7% depending on the source. That's roughly an 80 basis point jump in about 3 months. Now, why is this happening? Same story I keep coming back to. Mortgage rates are tied to the 10-year Treasury yield. The 10-year is currently around 4.57%, and it's been elevated because of two forces. First, the Iran situation. The conflict in the Middle East has disrupted oil supply through the Strait of Hormuz. When oil prices rise, inflation expectations rise. And when inflation expectations rise, bond investors demand higher yields to lend money to the government. Higher Treasury yields mean higher mortgage rates. They're correlated. Second, geopolitical uncertainty is making foreign buyers of U.S. debt more cautious. If countries are spending more dollars on expensive oil, they have fewer dollars to buy treasuries. Less demand for treasuries means yields go up. And again, mortgage rates follow. Now let's talk about the housing market itself. The latest data from NAR shows existing home sales in April came in at 4.02 million annualized. That's basically flat. The median home price nationally hit $417,800, still rising year over year. Inventory climbed to 1.47 million units, a 4.4-month supply. Better than last year, but still below what we'd consider a balanced market at 5 to 6 months. Here's the part that's getting attention: mortgage delinquencies. The MBA just reported that the Q1 2026 delinquency rate rose to 4.44%, up 40 basis points from a year ago. FHA loans are at 11.88%. Those numbers are climbing. But context matters. We're still well below the levels we saw before the last housing crash. Foreclosure starts ticked up slightly to 0.24%. Nothing alarming yet. So is the housing market crashing? No. Prices are still rising, just slowly. When do rates come down? That depends on the Middle East. If we get a ceasefire and oil stabilizes, expect Treasury yields to ease and mortgage rates will follow. If the conflict drags on, rates stay elevated or go higher. Watch the 10-year yield. That's your signal. That's where the answer is.